In this interview, we will address a number of financial topics. Information provided in this interview is provided for general information only. It is not intended to provide tax, legal, or investment advice, or to recommend any particular financial instruments, investments, or products. This information should not be used as the basis for making a decision to purchase or sell any investment. Always seek advice from your financial advisor with regard to your investment decisions and your attorney and accountant with regard to legal and tax questions.
Welcome once again as we talk to the Money Missionary. He is the author and the creator of the Worry-Free Retirement. He is Tony Walker. And Mr. Walker, glad to have you back. On our first show, we talked a little bit about your spirituality. Actually, that was really the thrust of the entire first show. But this show, if it's okay with you, I wanted to talk a little bit about your investment background, your insurance background, and a little bit more about the business side of Tony Walker.
Okay, very good. Yeah, I graduated in 1983 from Western Kentucky University. Actually, John, I had a double major. I had so many hours accumulated, I ended up having enough for a psychology major, which I loved psychology and thought about getting into counseling. And then I had, which I wanted to be the next Tom Brokaw, I had a broadcast journalism degree from Western, so I was familiar with production and all that. To be honest, I got out and I got married to Susan, my high school sweetheart. Man, I saw that was going to be a long road. I had a job offer for a camera person, or I could go to Grand Junction, Colorado for a nightly news thing, and I thought, well, I don't know if I can do this, married and all that. So I kind of floundered around. And the reason I tell you this story, it's funny how things work. I'm riding, my wife and I went out to dinner with her parents. I'm riding in the back seat, he's driving. And I'm trying not to act like I'm kind of worried about my future. I just married this guy's daughter.
Sure.
So Mr. Moore looks up in the rearview mirror, and I never forget, he goes, well, so what do you think you're going to do anyway? And I said, well, I don't know. I started him-hawing around. He said, how would you like to at least just try coming to work at my insurance company? He had a property casualty insurance agency there in Bowling Green, Kentucky. I think I thought about it maybe 3 seconds. I said, sure. I thought, so I'll try it. I didn't know what I was doing. So I started out there in 1984 making $11,000 a year. I mean, he didn't cut me any slack. I'm sitting there trying to figure out the ropes. Very difficult field at that time. High interest rates, people that know anything about the insurance field in 84, it was tough. And I finally said, Mr. Moore, I'm just not enjoying this. I was trying to sell home and auto, and he was a very educated man. He had a lot of advanced degrees in COU, CPCU, all this stuff in the insurance vernacular. And he said, why don't you look at, with your counseling background, estate planning and things like that? I said, well, I'll give it a whirl. Well, I loved it. I got to sit around and ask all kinds of nosy questions about what happens when you die and stuff that I was comfortable talking about. And a lot of people had never talked to anybody, so it opened up doors, and we talked about planning and life insurance and trusts, and I just ate it up. I got securities license in 1987. Back then, variable life, variable annuities were getting real hot. I thought those were cool. I was 27 years old. Hey, yeah, let's go for the gusto with those things. And then I got my CLU, which was an advanced degree in 1988. At that time, I was one of the youngest in the country with that. So fortunately, my father-in-law really pushed me. He did a good job of making me get educated, pushing me. I think I mentioned in the last show, we had some family issues with a brother-in-law. Best thing that ever happened, because it kind of kicked me out the door, and I had to do it on my own. But deep down, John, I didn't really want to do the overall insurance, property, casualty, agency. I kind of wanted to try to see if I could do it on my own. So then I focused strictly on estate planning. That's what I started doing in 1988, 1989. And, that's kind of where it was. That's really where I jumped off the roof by myself and started my own company.
Tony, not to go back to the spiritual side, but after listening to this, I think God had a hand in this. You met the right people who really influenced you business and really have played a big part in your success and your mission now, which is to let you and I worry less about our money. So you meet the insurance guy.
Oh, yeah.
You have a psychology degree, which I think helps you immensely in your business, and we'll talk about that. And I'm curious, though, what made you start having, I don't want to even say endorsing, let's just say an interest in annuities?
Now, that's a really good question, because although I'd sold some annuities, even mentioned the variable annuities, and I did a lot of life insurance. I mean, I wrote really, really big life insurance policies, especially in the 90s, because I'd call on a lot of large estate planning people. I'd go into a business and multi-million-dollar business, and I'd work with attorneys and all this, and we'd do things like buy sells, and I'd do estate planning, AB trust. I did a lot of pretty sophisticated stuff, got to work with attorneys and all that, and that was all great. But then the securities, the market started taking off in the 90s, and I said, well, shoot, I got a securities license. Actually, I did something nobody else really had done back then. I said, wait a minute, I don't want to be with a broker-dealer. Again, people who understand this business and know what I'm talking about. In the mid-90s, I became a registered investment advisor, dropped my securities license, got that so I could manage money under a platform with Charles Schwab, found no-load mutual funds, charge fees. Nobody was really doing that at the time. It was kind of unusual. That went really well. Hired a person. We went after that market, continued to do life insurance and some annuities, you know, but heck, I was riding the wave of that in the 90s. Things were going great. I was making a lot of money, charging fees. People making 15, 20%. They thought I was a guru, and I thought I was pretty good too. 9/11 happened. This, John, was the turning point for me. Again, you know, 1988, 89, when I had the problems with the family business, that was a turning point. You know, 1999, 91, coming back from Lexington, huge turning point. But all these things, as you said, were very positive in the work of God, of course. But then all of a sudden, 9/11 hits. They closed the stock market. I got millions of dollars under management. I got people calling me wanting to know what to do. Well, I couldn't do anything. I mean, people don't remember much about that. There were people in the investment world, and there were a few instances people called it quits, literally. Jumping off buildings. I mean, you kind of recognized, or I did at that point, I thought, wait a minute. I got Bob and Martha's life savings under my hands, and I've got it in a world that is totally out of my control, totally. I mean, the market tanked. Remember all that? I mean, it was very scary times. But what was ironic, once the markets opened back up and everything, and most of my clients' money had gone down 20, 30% in just a week or two, I was charging quarterly fees. This is a true story. I'm sure people think, oh, surely you didn't do that. So when the quarterly time would roll around, I would value their accounts normally. I'd go to Schwab. I'd bill Schwab. Schwab would send me my cut because it was in writing. I was able to do that. And I looked at one of my staff and I said, I can't do this. I cannot sit here and charge these people while their accounts are down 30%. So I waited another quarter. I couldn't do it. The market wasn't coming back. And I finally decided, well, this is crazy. I don't even like this. I'm a nervous wreck. I realized I'm really not that good at picking investments and managing money. I didn't like the feeling of it. I really wasn't an investor either. My heart was really in saving and playing it safe in conservative investments. I really wasn't a risk taker. Thought I was, but I really wasn't. You know, that's another cue. You want to know if you're a risk taker when you lose money and you're sick over it, you're not a risk taker. True risk takers, when they lose money, you know what they say to themselves? I'm getting closer to winning, buddy. No, really, that's how they're wired. That's okay, but most people are not, they don't have the stomach for that. So I started searching, and I went back to my original roots of insurance, protection, fixed annuities, not variable. Fixed annuities, dividend participating whole life, all these things that were always guaranteed. And you know what, after all that debacle with all the downturn, guess what? Those things were just steadily climbing, kind of like the tortoise and the hare. And I look back and I said, man, wished I just had those products. You know, so I just decided to cut bait. I said, I'm out of the money management business. Walked away from millions of dollars under management, a lot of fees. I did approach all my clients and say, this is what I'm doing. You can leave it with Schwab or I'm heading this direction. Some went, some stayed. That was fine. But I haven't looked back since. And since 9/11, John, you know, we have positioned ourselves intentionally as safe money specialists. We're more concerned about the return of your money than on it. We're not trying to grow it. We're trying to help you use and enjoy it. Now, we have learned over the years to be very crafty at minimizing taxes and fees. This is an eroding wealth that people don't pay any attention to. So I can show people how you can be conservative with money, but in many cases, we'll have much more money than the people over here messing around with Wall Street with all these fees, taxes, and risk. So I think our approach is much better. It is geared, of course, towards those who want to play it safe, keep it simple, and enjoy their money. That's what I do for people.
You're listening to an interview with the author and creator of The Worry-Free Retirement, Tony Walker. To schedule a no-obligation appointment with Tony, simply call toll-free 1-877-499-9255 or log on to TonyWalkerFinancial.com. Remember, there's never a fee or obligation to meet with Tony. We now rejoin our interview in progress.
I think there's a lot of us out there who agree with your philosophy. I'd rather have something that is secure, safe, and I don't know if so much is it a, you know, these days of 10 to 12% returns, I don't know if they ever existed. But with that being said, I'd rather be considered what you call a saver.
And again, now going back to my roots, my grandfather was a saver. He played it close to the vest, but he never worried about the things many of the people I run into are worried about. So you've got to make that decision, John. Are you willing to worry about your money? Now granted, in exchange, the Bible says count the cost, right? In exchange for a lot of worry, you could make a lot of money. But once you wade into those waters of Wall Street, especially with a lot of your money, I've got a little bit of money in the market. I'm not trying to act like nobody needs to be in the market. But once you really dive in, let's call it dive in instead of wading in. When you dive into that market, and you got all your money in growth mutual funds and stocks and high yield bonds and all this stuff, you got to understand you're possibly going to cost yourself a lot of money. It's dangerous territory for a lot of people. And you got to decide if you can stomach it or not. You know, the Dow back in, I think it was October of 07 was over 14,000. You know, people forget, what was that, almost 5 years ago? Did you realize it's not even gotten back to 14,000 since then?
Wow, I did not know that.
Yeah, people forget that. Oh, it's been bouncing around, it's edged up to high 13, but so here we are, we're all arguing over the market. The pundits are telling us to hang in there, and I look at the facts and say, wait a minute, in 5 years, this thing isn't even back to where it was in 07. You got to be kidding me. So if you were 60 years old, John, and you were told to hang in there, now you're 65, time's a wasted, right? I mean, you don't have much more time. That's the other thing. We work with a lot of people that are at or near retirement. These people don't have the time to make up all these losses. Our job is to come in, position their money on a safe basis, which fixed annuities do. They're one of the few items that can do that well. And then what we do is we set up a game plan like Granddad's pension so that when they're ready to get this mailbox money, the annuities can kick into high gear and provide that lifetime income that they can never outlive. Annuities, especially fixed annuities, are the only thing can do that without risk and without high fees. If it's okay, can I just go through the 4 types of annuities real quickly?
Yeah, I noticed you're a fan of the fixed annuity,
Yeah.
but I would like to hear about the others where we got variable. I know there's some hybrid annuities.
Yeah, I'll talk about that. That's a term that I kind of coined and some other people and everybody uses it, so I better explain what a hybrid annuity is. But let's just kind of go full screen here and let's talk about the 4 types of annuities. These are things we cover in our workshop, by the way, John. I would encourage people, if they're interested in really coming and see me, no obligation, but to attend a financial workshop. We have them in Louisville all the time. They're absolutely free. This is the kind of stuff I go into detail. But basically the 4 types of annuities, you have a fixed interest annuity. Fixed interest annuities are kind of similar to CDs in terms of how they behave. You give the money to an insurance company. Every year they pay a set interest rate, 2, 3% or whatever. But when that money is credited each year, you get a new floor. So let's say you have $100,000. You make 3% on your money, so at the end of the year you have $103,000. The beauty is, though, if interest rates go down or whatever, you don't lose your 103. That's your new floor. Make sense?
Makes sense.
Okay. The next type of annuity is a little different. That's a variable annuity. Those came out very popular in the late 80s when the market started taking off. I used to sell those in the late 80s, early 90s. That's really an annuity that's taking your money, and here's the key, they really are pretty much putting it in the stock market. So certainly, yeah, you can have some guaranteed income riders attached and all that, but the problem with those variable annuities, John, if the market goes up and you go up with it, if it goes down, there's no floor. Down you go. So for retirement planning, when you could have a fixed annuity to lock it in so you can have that guaranteed income without all the risk and the fees, the variable annuity to me just doesn't make a lot of sense. Okay. They're too expensive, too risky. Now the third type, this is what I like to call the hybrid. Other people call it the hybrid. This is what's called the fixed indexed annuity. It's very similar in nature when you first glance at it to a variable annuity because they link the return to the stock market. Now the beauty with this is, the genius of this product, which was developed in the late 90s, is that if the market goes up, you get a % of the market. We talk about this in the book, Don't Follow the Herd. I've got an illustration of this in the book, Don't Follow the Herd. It's a great illustration, but the concept is a cow and the milk. So let's imagine I've got a cow, and that represents all my money, and it's in the stall, right? The cow's in the stall, and it's a milk cow. Wall Street wants to take your cow in the variable annuity and take that and invest it. We're going to invest all of it in the market. The problem is, if that cow gets slaughtered, you're going to have less milk, right?
Sure.
So the concept of an index annuity is we're not going to take the cow and take old Betsy out of the stall. We're going to protect her and leave her there. We're going to take the milk Betsy produces, and we'll take that to Wall Street. So if we make money on the milk, it won't be as much money, but we can bring it back. We have a bigger cow. If we lose the milk, we don't cry over spilled milk because Betsy's still protected. So the hybrid annuity is a combination of a fixed annuity. It's very protected, guaranteed, but you can get some upside potential of the stock market. A unique tool, I use that a lot. And then finally, the fourth type is what we call an immediate annuity. That truly is the older type of annuities that people are thinking, well, when I take it out, I get an income, but when I die, there's nothing left. That's the older type annuities. We still sell those some and recommend those, but that's kind of like Granddad's pension. You set it up, it's paid out over a period of time, you get your principal and interest back, and at some point in time, when that period of time expires, the money's basically gone. That's what we call the least flexible of all the 4 annuities, because once you set it up, you can't change it. Okay, so those are the 4 types of annuities. What we do the fixed interest, fixed indexed, and immediate. We do not sell the variable annuities because it does not fit with the philosophy of our program, which is minimizing fees, minimizing taxes, minimizing risk. Okay, those are my 3 mantras. The taxes are okay on a variable annuity. The problem is you have risk and you have too much fees, so I have to kick it out of the equation.
You're listening to an interview with the author and creator of The Worry-Free Retirement, Tony Walker. To schedule a no-obligation appointment with Tony, simply call toll-free 1-877-499-9255 or log on to TonyWalkerFinancial.com. Remember, there's never a fee or obligation to meet with Tony. We now rejoin our interview in progress.
I love the sound of mailbox money. It's a little old school, but guess what? It still works in this day and age. Tell us a little bit about mailbox money.
When my granddad retired in 1978, and in fact, I did a documentary called Say Goodbye to Granddad's Retirement. It's currently marketed in school systems around the country. I tried to target that towards XY generation. I felt that was my contribution to them. This was several years ago because they're not going to have a retirement. And that's why it's called Say Goodbye to Granddad's Retirement. I was talking about my granddad. You know, his was the ultimate, the pension plan. And he called it mailbox money because literally I can remember we'd drive up the long driveway, we'd cross Highway 33 real quick, and there was that mailbox, and he'd pop it open and grab that check out of there. It came every month, that and his Social Security. It's funny, now when we do annuity planning for people, when we send them income, usually it's electronically transferred. People say, well, that ain't mailbox money. We have a company recently we started working with, and it was so funny. I was working with an elderly lady who needed some income, and I said, you're in luck. She said, why am I in luck? And I said, they won't do electronic transfers. I get to send you some mailbox money. So they're still sending checks. But I think she liked it. She liked going and getting that check. She's like my granddad. So yeah, mailbox money, the concept, it's real. Only annuities can provide it. The concept of mailbox money is it's a guaranteed lifetime income that you can never outlive. And what it means is every month it's going to show up, no matter how long you live. So no other investment can promise that, John. You know, let's say I went to the bank and put in $200,000, and just so I can do the interest factor real quick, let's say I'm making 2% interest, all right? So 2% of $200,000, I'm only creating $4,000 a year in interest, right? So you know a little bit about math. So if I went to the bank and said, well, I don't want $4,000, send me $8,000 a year. They could do that, but you're only making 4, you're taking out 8, what's eventually going to happen? You're going to what?
Well, that cow, as you said, is getting smaller, isn't he?
You're going to run out of money.
That's right.
Unless you're lucky
The
enough to
cow's
die,
getting
right?
smaller,
Yeah. Annuities don't work that way. They're taking the risk of saying, hey, okay, we'll do that. If you live a long time, you know, as the old used car salesman say, you beat the bear. If you don't live as long, we win. You know, so that's why I like annuities. I like insurance companies. It's more scientific. They're looking at actuarial studies. They see the playing field a little more clearly, and it's really not real risky for them. But it takes the risk off you. So if you do live a long time, you live 20 or 30 years, and you find out you're age 100, that mailbox money is not going to stop with an annuity. It's guaranteed for life.
When you say minimal risk, I like the sound of that. I also like the sound of minimal fees. If you're talking to an investment advisor out there, and how can you be ensured that they're being transparent about their fees? What kind of questions should you ask, Tony?
Well, one thing on TonyWalkerFinancial.com, we did put an annuity fee sheet. What I was seeing, John, is people would go out and somebody proposed an annuity, which is fine, fixed, variable, whatever it is, and they give them this information, and they'd want me to look at it, which I'm happy to do that. Well, Tony, what is this? Oh, okay. And immediately, which I could find the fees, you got to dig and find them, but I'd ask them, oh, by the way, did they share the fees with you? No, or they'd say, oh, 1%, real flip it. They don't understand the importance of fees, and the brokers aren't going to share it with you. So I created this annuity fee sheet. It's really a lot of fun. It actually can mess up somebody's day pretty quick, though. But you download it from TonyWalkerFinancial.com. You just click on the Annuity King icon. You go download this fee sheet. One pager, it's got the main fees of all annuities. What I suggest people do is before you buy the annuity, take the fee sheet, have the advisor fill it out, and here's the key point. They're going to have to sign off on that. Now, I've had people take that to advisors and they won't sign it because now all of a sudden it does become transparent. And if you've got to write on like some of these variable annuities charge as high as 4.5% a year, that means if you gave them $100,000, John, that means $4,500 a year is coming out of there every year. Well, they don't want to tell you that. I mean, that's too much disclosure. That's scary because they know that, gosh, we got to make 4.5% just to break even. That's hard to do. So I'm one about transparency. I always tell people the fees. Personally, we do not charge fees, by the way. We work only on a commission basis. I'd much rather do that. I'll let the companies pay me a commission. Our clients never even write me a check, ever. They're not out of any pocket to work with us. If we do set up an investment account for them, we set it up in a managed account, very, very low fees, and we don't even collect fees on that. So if people work with us, I guarantee you we'll have lower fees than anybody in the industry. I've made it a point to do that because I don't think in the general sense of the word, fees are fair for people. They're too high. I'm okay with reasonable fees, or if somebody has to charge high fees and they're providing a very, very good service to justify the fees, I'm okay with that. But this idea of shuffling mutual funds around and a few stocks in here and you're going to charge me 2 or 3% and my account's going down, that's not going to cut it. And that shouldn't cut it for the consumer either.
You've authored 3 books, Tony. One of them, and they're here on my coffee table, The 10 Biggest Misconceptions About Annuities. Rave reviews. I hear people all over the country are using this book now. If there was something you could tell our viewers in this little short time that we have remaining about these misconceptions about annuities, what would you say, in a nutshell? In
a nutshell, the majority of people talking about annuities, and especially the ones being critical of it, have no clue what they're talking about. They have never, there's either 2 problems. They've never really understood annuity contracts and the importance of them for savers, or they're people from Wall Street, because those are not securities products. Wall Street's all about securities products. A variable annuity is a security. A fixed annuity is an insurance contract. It's not a securities contract. It doesn't pay recurring fees. It doesn't fit Wall Street's model. So if you'll dig deep, if you find these folks that are just totally critical of annuities, fixed annuities, don't like them, don't recommend them, be careful, blah, 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 they've probably got an agenda or they just truly don't understand the product. We have researched these products. We've worked with them for years. And yes, and I'm grateful for this, but we have advisors and agents from all over the country contacting us and downloading that book, trying to better understand how these products work. So throughout the country, I'm kind of getting known as somebody that's very, very specialized with these fixed annuities, and we know how to use them appropriately for the right clients in the right circumstances. That's what this is all about. Remember, John, there is no perfect product for every perfect situation. It doesn't exist. Some products work good for certain situations. Other products work better for other situations and other people. What we've done and what I've been able to do over the year, and I've become very successful at doing this, it's nothing magical. I just find people that I know fit that product, and I go talk to them. That's what we're doing on the show here. This show is about finding people that are watching the show going, that's what I've been looking for. For the guy watching the show or the gal watching the show going, I like investments, I like doing this and that. Great. I'm not for you. That's good news. We both don't have to waste each other's time. And that's a good thing. That's the way business should be conducted. People relating to one another that have similar values, interests, and goals. That's what this is all about.
You're listening to an interview with the author and creator of The Worry-Free Retirement, Tony Walker. To schedule a no-obligation appointment with Tony, simply call toll-free 1-877-499-9255 or log on to TonyWalkerFinancial.com. Remember, there's never a fee or obligation to meet with Tony. We now rejoin our interview in progress.
Tell us more about Tony Walker and the way he does work. You mentioned 3 and 4 appointments. What would the first appointment be? Is it a fact-finding mission? What do you do?
Very good question. Yeah, that's a good way to put it. It's a fact-finding mission. Even watching this show or they've been to a workshop, people will say, well, yeah, I want to meet with you, Tony. Or they just call and want to meet. That's fine. They'll sit down and talk to me, and the first meeting they're thinking, I can tell they're thinking, gosh, is there something wrong with him? He's not talking much. And sometimes I'll tell them, now, by the way, I'm here to hear from you. You don't want to hear me talk. If an advisor is talking a lot at the first meeting, that's a red flag because they're not interested in your needs. So the first meeting, I look at all their financial information, tax returns, if they want anything financial related, I look at, I get a feel for what they've got, why they've got it, and where they're trying to go with it. And then I find out a lot about their family and their other issues. That's the first appointment. Second appointment, I come back with a full-blown assessment. By the way, no cost, no charges, no fees for this assessment. I lay it on the line. Based on your situation, John, here's what I'd consider doing. Do you have any questions? Now, some people, it happens every once in a while, they'll say, this is exactly what I want. Let's move forward. Let's do business. They become clients. In many cases, I can tell when they look through it. There's a lot of information, some of it different from what they've seen, maybe from a broker or whatever. I'll say, take it with you. It's yours. That's your information. Make questions. Write questions. If you need to talk to family, if you want to bring a family member back in here to meet with me first, because we have a lot of seniors. Bring your child in. I don't care. I'd love to meet them. But make sure you understand. Then when they come in the next appointment, they feel more in charge, and they've got some legitimate questions. I answer those questions. That's what I say. Sometimes even after the third appointment, especially I work with a lot of widows. I've mentioned that. A lot of those widows, I really encourage them to go a little slow. Don't go too fast. And then a lot of them appreciate that fact in our process. So it's in your court. It's at your timetable. We just want to make sure we're talking to people who are serious about our services.
You're listening to an interview with the author and creator of the Worry-Free Retirement, Tony Walker. To schedule a no-obligation appointment with Tony, simply call toll-free 1-877-499-9255 or log on to TonyWalkerFinancial.com. Remember, there's never a fee or obligation to meet with Tony. We now rejoin our interview in progress.
I know relationships are important to you, Tony, and it's an ongoing process because, we talk about the workshops, you just talked about the one-on-one meetings, the follow-ups, etc. Lunch and learns. I know you have a little meeting situation where people can have lunch and learn a little bit. This is with your current clients. With that being said, how important is that to keep your client updated? Because as you said, and as your grandfather and your father said, nothing stays the same. So with things changing, both economically and maybe they're getting closer to retirement, how important is it for you to stay in touch with your clients?
Well, and we talked about this yesterday. I started those lunch and learns because, quite frankly, John, I'm the main advisor. I'm the only advisor. I have an office full of great staff that provides support for me. But at this point, Lord willing, seriously, if I can continue to meet with as many people as I can and provide them my expertise of almost 30 years, I think they want to hear from me. I hope that doesn't sound egotistical. It's just that they understand that I know what I'm doing with the situations at hand, and if I'm going to give them advice, it's the advice that I feel is in their best interest. If I'm not sure of something to do for them, I'll send them to another professional if there's another specialty. But if I know what I'm talking about, I'm going to tell them, here's what I think you ought to do. With that said, as you get into clients and the growing practice, that's why I've had to get creative. That's why, and I've had people tell me, Tony, we appreciate this. I have client lunch and learns now. I had one yesterday with 24 clients. You know what we do, John? We just go over the annuity contracts we've sold. We go over, it's refresher courses because I want them to know I'm here for them. But a lot of times people just want you to, they want to be reminded that you care. They want to know that you're going to spend some time with them like you did when you were first barking up a tree wanting their money in the first place.
Sure.
That's the biggest complaint I hear is the broker or the agent or whoever, man, I seemed like they were their best friend. And as soon as I wrote a check, I haven't heard from them again. That's not what we want to do in the practice. Now, with that said, let me say this. I've been blessed to come up with a way to put this on autopilot for a lot of people. That's why I like annuities. Annuities, for the most part, you don't change them a lot. See, I like that. That's in the best interest of the client. If I put a plan together for you, John, that's always constantly changing, or I got to monkey with it or rebalance it, you're going to have to wonder if that's the best thing or if that's in your best interest, right? But if we get something that's good, that's working, why change it?
Sure.
That means you don't have to worry about more commissions, more fees, more agendas. You put that sucker on autopilot and enjoy your money. That's what this should be all about.
Well, I like that part of the equation. Worry-free retirement includes enjoying your money. All right, Tony Walker, thank you so much. In the first show, we learned a little bit about the spiritual side of Tony Walker. Now you hear a little bit more about the investment, the business side of Tony Walker. And we're going to do it again right here on this station, 1:30 on Fridays, and you can catch Tony Walker on Wave 3 at 12 noon every Monday with It's Your Money. All right, the Money Missionary, Tony Walker, thank you very much.
Thank you, John. I really enjoyed it.
And we'll see you next time.
We hope you've enjoyed this interview with the author and creator of the Worry-Free Retirement, Tony Walker. To register for Tony's next free workshop or to schedule a time for Tony to personally review your situation, just call the number on your screen. Or better yet, log on to TonyWalkerFinancial.com. We look forward to hearing from you.